welcome to the deep dive. Today we're tackling a really interesting piece of investment advice.
Yeah, this one's from Mansi.
Right, specifically about, allocating capital in the stock market, how you split your money.
Exactly. And our mission really is just to unpack her trading tip 9 and see what it could mean for you listening.
Okay, so we've got this specific tip, number 9.
hmm It gives actual percentages for different market cap categories.
All right, let's get straight to it then. What does it say?
Okay, it's pretty direct. Quote, never invest more than 10% of your capital in small laps.
Okay, 10% small caps.
Then never invest more than 30% of your capital in mid caps.
So 30% for mid caps, got it.
And finally, invest at least 50% of your capital in Nifty Bs.
At least 50% in Nifty Bs. Wow, okay, so a very clear structure right off the bat.
It really is. It tackles that big question, how much do I put where? Gives you a framework.
Definitely. So let's break it down. First up, small apps, small caps.
Yeah.
What are we generally talking about here?
Well, small caps are typically smaller companies, right, in terms
Yeah.
of their total market value.
Okay.
Smaller value, which often means they might have more room to grow, potentially faster growth than, say, huge companies.
Uh-huh. High growth potential.
But, and this is the key thing, they usually come with higher risk, more volatility. Prices can swing, quite a bit more.
Right. Much bigger ups and downs potentially.
Exactly. So that 10% cap, it suggests being pretty cautious here. Dipping your toe in, maybe? Not diving head first. Plus, sometimes they're less liquid, harder to sell quickly if you need to.
Okay, so small slice, potential high reward, but be aware of the risk and the bumpiness. Makes sense. What about the next bit, mid caps?
Mid caps are sort of in the middle, as the name suggests. They're generally, more established than the small caps.
A bit bigger, maybe been around longer.
Often, yeah. A more stable track record, perhaps.
Right.
But they usually still have decent potential for growth, maybe more than the really large companies.
So kind of a balance.
That seems to be the idea. The 30% limit here suggests taking on a bit more exposure than with the really big guys, but still, keeping it measured. It's not the bulk of the investment.
Right. Not as cautious as small caps, but not the main event either. Which brings us to the main event. Invest at least 50% of your capital in Nifty Bs. What exactly are Nifty Bs?
Good question. Nifty Bs are ETFs, exchange-traded funds.
Okay, ETFs.
And specifically, they track the Nifty 50 index. Think of the Nifty 50 as like the top 50 big actively traded companies on India's national stock exchange.
So the major players in the Indian market?
Pretty much, yeah. So investing in Nifty Bs means you're essentially buying a small piece of all those top 50 companies in one go. Spreads things out.
Diversification built in.
Exactly. And recommending at least 50% here. That really emphasizes stability, I think, anchoring your portfolio in these large established Indian companies.
So when you put these percentages together, 10% small, 30% mid, 50% plus large via Nifty Bs, what's the underlying principle, do you think? What's the strategy?
Well, looking at the whole picture, it really seems like a strategy focused heavily on risk management.
Managing risk. How so?
By putting the biggest chunk, that 50% or more, into Nifty Bs, you're grounding the investment in what are generally seen as more stable blue chip companies.
Okay, the foundation is stability.
Right. And then the smaller bits in mid and small caps, those are for the growth potential, but it's capped, limited exposure.
So you get a chance at higher returns, but without betting the farm on it.
Precisely. It feels like a somewhat maybe conservative approach, prioritizing the perceived stability of India's biggest firms over maybe chasing higher but riskier returns elsewhere.
Though someone else might argue for more in mid or small caps if they have a higher risk tolerance, right?
Absolutely. If you're aiming for more aggressive growth and can stomach the bigger swings, you might allocate differently. This is just one specific suggestion.
So for you listening, the value here is that it offers a pretty straightforward starting point, doesn't it?
Yeah, if you're feeling a bit lost about how to divide things up, this gives you concrete numbers to think about. A clear structure.
Takes away some of that, where do I even begin feeling?
Exactly, a tangible strategy.
Yeah.
Doesn't mean it's the only way, but it's a way.
Okay, so let's try and summarize the key takeaway. Mansi Suryawanchi's tip offers this structured allocation. Heavy on large caps via Nifty Bs for stability.
At least 50%.
With limited controlled exposure to mid caps, about 30%, and even less to small caps, just 10%.
Yeah, likely aiming for that balance between getting some growth potential while trying to keep the overall risk in check.
Right, which leads to a good final thought for everyone listening.
Definitely. You really need to ask yourself, how does this specific 10-30-50 split feel for you? Does it match up with how comfortable you are with risk?
And what are your actual goals? Are you investing for the long haul, short term? What kind of return are you hoping for?
Exactly. What are the pros and cons of sticking rigidly to these percentages for your situation? Maybe this is a great starting point, but perhaps you need to tweak it.
So, what further research or thinking might help you tailor your own capital allocation? That's really the crucial next step, isn't it? Moving from a general tip to your personal strategy.